Welcome to the Real Estate Investing Club. This is the place everyday real estate investors gather to share their best stories, biggest insights, and favorite tactics to grow a portfolio of cash flowing properties in today's market. Here's your host, Gabe Peterson.
Three, two. All right. We are back with another episode of the Real Estate Investing Club. Today we have Patrick Grimes with us from Invest on Main Street and PassiveInvestingMastery.com. Patrick has been investing since 2007 with a real estate portfolio valued at 600 million plus. A lot of experience. He went through the 2008 crash and he's ready for this next one. We're here to talk about recession-resistant acquisitions and taking advantage of the recession on the upswing that we're going into right now. So, Patrick, I'm super excited to have you on. Thank you very much for hopping on the show.
Glad to be here, Gabe. You've got a podcast right after my heart, talking real estate.
There we go. I told you before we got on here, we like stories. We like to hear how people got to where they are today. So why don't you take us back to your story? How'd you get started in real estate?
Yeah, so I actually was an engineer starting out. I went to mechanical engineering school undergraduate, and I had an affinity for that early on. Not like Dilbert extreme, but close. And I started out as machine design, automation, and robotics and engineering. And the owner of the company I work for, he encouraged me. He said, "Look, you're going to do great in high tech, but don't invest your money there. Put it in real estate." And his only regret from founding this very successful high-tech company was not investing more in real estate sooner. And so I jumped in there hoping to double, triple my money, and made some bad bets. I invested in pre-development, and then 2009 and 10 happened, and I was raked over the coals pretty hard. I kind of came bouncing back a number of years later as my high-tech career grew. I got a master's in engineering and business. And I scaled into single family buying for cash flow, recession resilient markets, things that allowed me to ride out recessions like low leverage reserves, and building a really built to last and recessionary resilient. I don't like to say resistant because nothing's purely resistant, but resilient. And then I founded Invest on Main Street and traded up to private equity syndications and larger apartment buildings, and we've done diversified energy funds and a number of other assets that help our investors diversify out of the stock market.
Nice, man. I love it. And I never like to hear investors having to go through being kicked in the teeth. It happens to all of us. I feel like, we always go into all of us. We have those deals that just didn't turn out the way that we wanted. And a lot of it is, comes with experience, comes with going through a number of deals, understanding what, the market cycles and everything like that. So I don't like to hear that you had to go through that, but it sounds like you got some great wisdom from that experience because it allowed you to springboard to where you are today. So let's, just take a moment to kind of hone in on that moment when you were investing before the 2008 crash. What did you really take away from that once you, once the crash happened and you had some hindsight, you were able to look back? What were some big lessons that you learned from that?
Well, quick teaser at the end of this podcast, I'll be happy to give away a free copy of my book we ship out that'll tell the whole story. Mm-hmm. And so if you wait to the end here, we'll give you the link and the promo code. But love to inspire individuals along the path. I was, like many of your listeners, a high tech or some kind of professional, doctor, lawyer, who was making income, and I was climbing the ladder, and I wanted to, do the American dream. I wanted to become like a landlord, become an owner, right, and buy real estate. And but I was inexperienced. I didn't know what I was doing. I hadn't been through a downturn before, but I did due diligence, and I looked kind of in the near term history for what seemed to be the highest returning investments. And that was sort of in these high growth markets where you could get in early and do a pre-development, residential pre-development. And so I bought in hoping to double and triple my money.
By pre-development, do you mean like just buying land, platting it, and selling it off to developers?
Well, so being me, that was going to build on it, right? So
okay.
Even being able to build on it. And then getting into that point. And then so the hope was not only do I get land that I can then get ready for development, but then I could actually build on it. right?
Mm-hmm.
And so there was kind of like a double leap of when will this cash flow? And let's hope that the market doesn't fall apart until it does start to support itself. And I put everything into it, right? Because market was never going to go down. This was 2007, right? So so the lessons learned was just, there's quite a few. There's kind of unpacking the onion was to invest, not speculate, and investing for cash flow and buying right, and buying something that values more, working harder to buy something that values more the day you buy it and not on a hope, buying something that supports itself, that cash flows, that can ride out recessions, and most importantly, buying recession resilient markets, ones with, that not only assets and cash flow, but people that can potentially rent from rented immediately. And those are supported by employers which have some built-in resilience and insulation, like health, vertical economies that have diversification, and things like logistics and finance and healthcare, and things that tend to hold up in recessions. And so there's a number of other things, but I learned a lot, and to be the tortoise, not the hare, mostly.
I like that.
And, I came out kind of embarrassed, and it took me a while to get back into it. But when I did, like you said, it was the right mistakes to make at the right time, which allowed me to then be more humble and scale systematically.
Yeah. Yeah. And there's there's no need to feel embarrassed. That happens to all of us, getting into deals that just don't work out as we had planned. And so, you're with the best there. I'm glad you bounced back. It's really hard after, getting kicked in the teeth to bounce back from that and decide, I'm going to do this anyways. I know I made a failure, but everybody has failures. So glad to see you're here. And you're doing well. You're doing great. You have your fund. I want to talk a little bit more about that, because you've mentioned a few times recession resilient markets, and that's something, we're in a recession now, and so it's something that's very important to understand. Usually people talk about recession resilient assets, so you're talking about like mobile home parks, self-storage, stuff like that. I don't often hear people talk about that when they're speaking of markets. So tell us, what in your mind is a recession resilient market, and how can people go out there and kind of identify them for themselves?
Sure. Well, they tend to be locations where you see a combination of factors. In general, there's every market in the United States undergoes cyclic cycles, and they tend to go on this expansion curve, and then they get to like this hyper supply. And then when people are so excited that they're expanding and growing, and that's the time to invest. But then they get oversupplied and prices are too high, and then they go to recession and then recovery. And so you want to find those markets, and tend to be those markets that are in that expansion curve are places that are bringing people. There's population growth, and
Dallas, Jacksonville, Nashville, places like that.
Yep. But you got to look at a couple more things, because you also got to look, is it legislative friendly? Because jobs come and those attract people, right? And if it's legislative friendly, then it will make it a low cost place. Typically, that lends to being a low cost place to do business, as well as a low cost place to live. And so with those two, you're going to see sustained growth of the economy, right? And if you're in real estate, it's really people. It's about, if you're in the people business. And so you want to look at that. Then you want to look at, what are the jobs that are in there? Like I was saying earlier, some of the biggest losers are the high-tech hubs like San Francisco and San Jose. And because they're heavily indexed in one vertical, turns out that can be very transitory. And while people growing and jobs are increasing, those tend to ride waves. And what I learned was that I could pretty much predict that I was going to lose everything if I had looked at the right economic data, right? Because you can look in the past and you can see, what particular markets in the southeastern states actually held true during recessions. Like Houston, where I heavily started out, and I'm in both single family and large multifamily, but it basically leveled off in 2006 and 7 before it started going up again. Whereas places like Vegas and Phoenix and New York, there's 14 years before you even broke even again.
Oh,
So you got to
wow.
find
I
those
didn't know that.
diversified employment makeup ones, like I said, that are recession resilient. Got to find people moving there, legislative friendly, landlord friendly. And then you got to find the right asset, right,
Mm,
within it to invest. And those are ones that I don't believe that if you want to be real recession resilient, I don't believe that's the prime double A new construction because
mhm.
people are living there by choice. And when people are sizing down, they don't tend, there's nobody really sizing down to that asset class. They're already topped out. And there's not much when you buy those to improve and sort of force your rents up. You're kind of hoping that the market stays true and that the renters keep wanting to rent because they're renting by choice because there's other options. I tend to like the workforce housing kind of blue collar, B and C class, what we call them, apartment buildings that have been around for, 20, 30 years that maybe we can buy from somebody who's neglected them and we can fix them up. Now that's recession resilient because if we buy something that we can fix up, well, we're creating value right off the bat, as opposed to hoping. And we're doing that by going to work instead of just holding. And that helps. Plus, people in the A class apartments will scale down in a recession. So there's a higher demand for something that we can create value on by working hard. So I kind of tend to lean in those ways.
Yeah, yeah, that makes sense. Sounds like a good plan. So you guys, you look for your markets based on the legislation. Is it friendly to landlords? Is it friendly to businesses? Is it attracting people to those locations? And then whether the market itself is growing, if there's a net positive migration, you look for that. Once you locate a metro that you want to invest in, how do you identify those, value add properties that are within that market? Do you reach out to brokers? Do you look at specific neighborhoods? How do you really define which assets you want to be investing in?
Right. And so what we've kind of talked about is the strategy. I almost want to say through and pre-COVID, where we do this value add strategy, that's what built a portfolio to last and ride out a recession, I believe. And the other components we haven't talked about are, did you get fixed debt, or did you get a rate cap, and did you put low leverage, and did you structure the foundation right? But if we're talking about like today, now, what are we doing for acquisitions moving forward within these markets? It's a very different equation right now. Why? Because the real estate market is on that reset. So things that we've created, the value, the properties we purchased and the value we've created, we're writing out a bit of a title decrease, right? In that market. Now we have low leverage, which means very little debt. So we're cash flowing. We created value by improving the units. So we're okay. We've got fixed debt or rate cap debt that allow us to ride out a recession like this, but we're not doing those deals. And I'll tell you why, because the value add strategy, which you mentioned value add yourself, that means we're going to have to buy something that needs improvement. Well, right now with inflation the way it is, we're seeing the cost of those improvements go up. We're seeing the scarcity of the labor to do those improvements happen, and the timeline extend for those improvements while the tide is lowering. So the traditional buy at something that you can level up over the course of a couple of years as you renovate maybe 100 units, that I'm not favoring that right now. Not that it's a bad strategy, but it's not the best for today. And that's why when we talk about recessionary acquisitions, which is our current push, we're talking about what are we looking for now? Right now, we're seeing wildly discounted and great buys by motivated individuals that have great performing properties, but weren't all the things that we were discussing, didn't structure their deals right, had floating rate debt, didn't have a lot of experience, didn't create the value, didn't have a bunch of reserves on the sidelines, debt's coming due, a lot of different things that cause people to mismanage during COVID, have high delinquencies now, to become distressed owners, not distressed assets. These are great buildings. But what we're seeing is that's throttling up. And so with the recessionary acquisitions, we're not looking for, hey, what's a property that we can buy and then we have to increase rents to get our returns? Not what's a property we can buy and we have to hope that the market will increase to get our returns. We're doing off-market deals direct to owner. We have this large engine, just searching out, talking to thousands of people, pulling 200 viable opportunities. And we're finding those individuals that need relief. They need to offload the asset and they need to get out immediately. And we can come in and with funds we've raised through our fund, and we can just pick that up quickly and be that source of relief. And we know before our funds even go hard in the deal that we can get the return on the buy. And this is the time, this is the season to get that upside of the downturn to balance out the tidal lowering of the rest of your real estate portfolio. And that's how we're doing it right now within those markets.
Yep. Yeah, that sounds like a solid strategy. You know, the market is never 100% predictable. You never know exactly what's going to happen. So you're talking about how the market's kind of at a situation right now where there's a lot of, distressed sellers are becoming more and more frequent. And they are looking for people like yourself who can come in and kind of purchase them at a bit of a discount in order to alleviate the issues that they're experiencing with their own operations of the property. How long do you think this period will last where those assets, those distressed sellers are at a position where they need to be selling for a discount of their property?
There's over $1 trillion in commercial real estate debt coming due over the next year.
Oh, wow.
Yeah.
That's a lot.
Well, I mean, some of the deals we do are, 100 million, 200, but to be clear, that is a lot. That's a lot. Now it is concentrated in some other assets, and, multifamily tends to be the most stable. So commercial is, office, retail, but like in COVID, what took a big hit was retail, right? Nobody went to the store. And now people are all working from home, and we're going to see office take a colossal hit. Why? Because they had long-term debt, and that's beginning to become due, and there's going to be a reckoning in office. But what we're seeing is, especially now, like I said, we're coming about 200 leads in as little as a month, and we're only picking up one or two of thousands that we're sifting through. We're using intelligent software and a lot of people and specific metrics to find where we're to locate these distressed owners of these kind of medium-sized assets. But that'll at least be going for a year or two. And I think that what's interesting about it is the interest rates are going to go up a little bit more. They're maybe close to the top. They're going to slowly step down. The reason why it'll last a year from now is because what the bank's coming due, whether or not they like it or not, they have to refresh their debt. You have to find a new lender or refinance. So that's a forced restructuring of their debt, and they're probably going to have to exit those properties sometimes at a loss if they didn't build it with the foundation that we talked about. But on the other side of that, as interest rates slowly decrease, as we've seen that they slowly will as they track inflation, there's going to be in year 2 and 3 from now still people that were living on the hairy edge. As they say, when the tide recedes, you can see who's swimming naked, right?
Yeah.
That are still going to need this. And that's why we have an overwhelming amount of these now. And I believe that's only going to go up. And it's going to be 2 or 3 years before we stop seeing these. And that's why the best buy right now is to make your return on the buy instead of hoping, right? And then do it within the fund. We're actually doing a 1031 exchange within the fund instead of just cashing everybody out and then go to the next buy and then do a trade forward and go to the next buy and do a trade. We'll go to the next buy. And that's our strategy, is to continually trade these forward in a way where you get some really exciting returns because the volume is there today, unlike it was, in prior years.
Yeah, that makes sense. So you're seeing really the biggest opportunity is within the next year. So June of 2024, between now and then, you're seeing a huge opportunity for these distressed sellers to kind of come to market, and then it'll also start to trickle down over the 2 to 3 years after that.
If I look at my crystal ball, I was at a mastermind in Dallas, and I talked on a panel with some economists in Chicago, and everybody's looking in their crystal ball. But the most important thing is there's deals like that right now, and it's important to jump on it right now. And Warren Buffett says to be greedy when others are fearful. I don't necessarily like the quote. I'm an analyst by nature. I'm a mechanical design MBA that I just love the numbers. And the numbers make a lot of sense right now. And that's what I care about. So,
yep.
Yeah.
Absolutely. You mentioned a few times right now you guys are sifting through a lot of leads, which means you generated those leads. What's your guys's favorite way to get off market leads? Because that is the place where the best leads are found, is off market.
Yeah. So we do have a proprietary system with a partner of mine that it costs about $200K a year just in software, with intelligent analysts doing sifting and sorting through. And then we have an outreach team which reaches out directly. So there's
cold calling
the hard way, right? Yeah. No, not just that, but there's a lot of different strategies we're using and different channels. But it's not easy. It's a lot of work and it's expensive. But in this kind of market, you need to invest and work harder to find the right investments.
Yep, absolutely. All right, man. Well, I loved everything you shared so far. I took a peek at the clock. It looks like we are running it down. So I have to move us on to the quick question round. Are you ready?
I'm ready. Let's
do it. Starts with books or any form of education. Give me 2 recommendations, one for general life wisdom, one for real estate.
A CEO Only Does These Three Things by Trey Taylor. A CEO Only Does These Three Things by Trey Taylor. He's an incredible person. This book just came out. He's already been to MIT. He's flying all over the country. If you're very serious about developing and empowering your company, I recommend you read that at least 5 times or listen to it on Audible. I actually run around the lake every morning to educational content, usually at 1.5 speed. I slowed it down to 1.25 and then I slowed it down to 1. And that's probably the best compliment I can give. And then I went through it another time on 1.
So slowing it down to 1 is the best compliment. That's funny.
Yeah. And that's what I told Trey too. I actually talked to him and I told him, I was like, that's the best compliment I could give you right now.
I love it. And I just pulled it up on Amazon. A CEO only does 3 things. Sounds like a good one. I'll have to pick that up. How about for general life wisdom? Or was that general life wisdom?
That was general life wisdom.
Yeah. Okay. Yeah. How about real estate?
And so real estate, I specifically in real estate, man, there's no other one that shows up other than the Purple Book, right?
Rich Dad, Poor Dad.
I mean, that is the ultimate, and not to be cliche, but I tend to have been through a lot of real estate books, and now I tend to read more of the ones that are more general life or business consulting kind of.
Yeah, Rich Dad, Poor Dad. That is a solid book that I'm sure every investor has at least perused. It's a good one when you're just getting started. It gives you an overview of why you should be investing in real estate. So love that. Moving us on to the next question. This is for your younger self. So let's go back to the Patrick who was, pre-2008 crash. He was looking into those pre-development sites. Go back to him, look him in the eye, give him one piece of advice moving forward.
Well, I think that and I'm doing a TED Talk on this, so I'm going to just summarize it, but I think there's a fallacy in the American dream here that my advice would be to not go the traditional path. I was climbing that corporate ladder, doing everything to be successful, and I was successful, but that had me investing in IRAs and 401ks, and then trying to be an owner of real estate and doing it all myself. And that was how it's supposed to be. It turns out that's really risky, and you can lose everything. And either your assets are in volatile indexes that your employer or your financial planner has you, or you're signing personally on loans and you're trying to be an expert in real estate, which you're not, which I wasn't. And I'm risking losing it all, which I did. And the reality is, if I would have just taken an unconventional path like I am now, found partners to trade up with, and not sacrifice so many years of moonlighting away from my family, friends, and hobbies, and partnered sooner, then I would have found my way to these private equity investments where I can get most of the benefit, but have a better team, diversify in better markets, and scale quicker. And it wasn't until we did that and I left single family behind, and we got into multifamily and energy, and now we're doing recession, that my wife and I really started to see our business scale, and we were able to get free of it all.
Nice. Yeah. Finding the right partners is so crucial. Finding good mentors and good partners can move your career along so so much faster than you think. So I'd love to hear that worked out for you guys. Next question is about your business. The first three positions we hire for form the foundation of our business. So what were the first three positions you hired for, and would you do it differently if you did it again today?
Before we continue on with today's guest, I want to tell you guys about a community I'm launching on Skool to help investors like yourself grow your own portfolio. In this community, you'll get access to all the docs I use, all the systems I've built, everything I've used to grow my own portfolio, as well as instructions and guidance on how to get out there and find great deals, how to finance those deals, and then how to manage them for great returns. Since we're just launching it, the price will be set at a measly $20 per month, and whatever price you join at is the price you'll have for life. We will be increasing the price as the group grows, so if you're at all interested in growing your portfolio along other investors, now is the time to join. I will put the link somewhere in the bio or on our podcast website at therealestateinvestingclub.com, so if you are interested, head on over there. With that said, let's get back to the podcast.
So let's see. I first hired a VA. That was my very first hire, like full-time. These are full-time hires or these are contractors?
You can interpret it however you want.
So I first hired a full-time VA, and that was a game changer. Out of the Philippines, she's been with me since the very beginning. She never left. She's just the greatest person. She's had 2 kids now.
Nice.
Unfortunately, she's on a maternity leave again, but fortunate for her, she's on a maternity leave again. But just love her to death, and she's incredible. But that was the first. The second, now I tend to be the engineer that keeps my head, real close to the grinding wheel, getting the work done, not really getting myself out on podcasts or in books and stuff. So I hired a director of marketing, and that was a game changer for me because I was actually out there doing really cool things. We had really great deals. We had thousands of units at the time. Now we're 500 million, almost 5,000 units, and also in energy funds and all kinds of diversified stuff. But at the time, I had nobody knew about me, but I was doing all this cool stuff. And what was really cool and empowering was to get the right person in the right seat to kind of get my story out there, to get our company out there. And people were just drawn to us after that. So the director of marketing was incredible. And then the third one was some help with talking with investors. I participate in every single investor coming in to at least in the initial call, but having somebody to help out, better service, more dedicated to consistently following up with getting the investor reports out, explaining the new investments to new investors coming online. And I actually I'm way too available. I love talking to people, but that obviously was a bottleneck. I appreciated being involved in my investor's life, but having somebody there that they can catch any time of any day was such a better service to them, and it allowed us to scale.
Nice. So VA and then marketing admin and investor relations. It sounds like you did focus in on your strengths, which is exactly what everybody needs to be doing. And then you hired for the positions that you were not had as your strong suit. So love to hear that. Next question is about the US. It's a big place, a lot of opportunity out there. Give me the single city, the single metro you're most excited about investing in today.
My tried and true long-term metro is still Houston.
Houston.
Yeah. And I could debate with some economists on this, but I'm still to this day very favorable about the employment diversification there, the recession resilience, the growth, the landlord friendly, the legislation, and the steady state of it, not the hyper swings of it. And I think I'm more excited about the old tried and true, right? Yeah. Than I am jumping on the hare and trying to race to the finish line,
Yeah. I mean, the Texas Triangle, Houston, San Antonio, what's the last one? What's the Dallas one up there? Austin. Oh yeah. And Dallas. those are all solid markets. Houston is a great one. And I'm with you there. I like markets that are they just slowly go up over time, not the ones that go crazy up, crazy down. I don't need any of that in my life right now.
Been there, done that, didn't like it.
All right, next question is about mentors. Mentors form or none of us are islands. We all stand on the shoulders of giants. I need to know my own bylines here. So who is one mentor who's contributed significantly to your career today?
Well, so when I started out, I said, look, I'm not doing single family anymore. And I'm going to trade up to larger, more sophisticated commercial real estate, multifamily apartments and others. I spent 2.5 years kind of interviewing a mentor. I met a dozen different partners, more than that, but a dozen I actually thought we might do business together with. And the one that I found that was most in alignment with where I am as a risk aversion, long-term focus was Robert Ritzenthaler. Just an incredible guy. And like me, he's not out in the limelight. He's getting a bunch of stuff done. And it takes a while to meet those kind of individuals. And he was the guy that I, blood, sweat, and tears with to get into the game after a long journey. And that I, closed my first few deals with. And so definitely very happy with my collaboration with him.
All right. Well, shout out to Robert. Thank you for helping Patrick get to where he is today. That leads us to the very last question. This is for the listeners. You've given us a lot to think about. I'm sure people want to reach out, get in contact with you. Where can they find you? And then I know you mentioned a book. Where can they find that? And what do they need to do to get their hands on it? Yeah.
So invest on mainandthenstreet.com, all spelled out. That's our company. Investonmainstreet.com. And we have Passive Investing Mastery, which is an educational platform we're building out to kind of give back and try and bring as much educational content around alternative investing outside of the stock market and how to build a portfolio that's long-term resilient. And join us, opt in on both those sites. I'd be happy. We do have ability to set up a call. I talk to anybody who's interested. There's ability to set up meeting on my calendar. I can kind of understand what your goals are, and hope get you pointed in the right direction. We do have a book out. This was my first time getting my whole story out there. It was Persistence, Pivots, and Game Changers, Turning Challenges into Opportunities. Brian Tracy did do the foreword, and there's Phil Collins of the Def Leppard, NFL, NBA players, entrepreneurs, a musician. Just, we had such an amazing time. I'm there with hair. Wasn't that long ago, actually, a couple of years, and my hair's gone. But it made an Amazon #1 bestseller. It was such an incredible opportunity. So many great stories. It was very inspirational for me to just be a part of this. And I tell my whole story. I'm happy to give a signed hard copy to anybody that, specifically your listeners, if you give me a promo code, they go to investonmainandthenstreet.com/book. It's a secret link, investonmainandthenstreet.com/book. And then would you like to put in the name of your podcast, the Real Estate Investor Club? And if they see that in the promo code, my team will send you a copy of that. And hopefully it leads to us having a conversation someday.
All right. I love that. So that is investonmainstreet.com/book. You can put in the promo code, the Real Estate Investing Club, and you guys can get your hands on that. So Patrick, that wraps it up. Thank you very much for hopping on the show.
Absolutely. Thanks, Gabe.
Absolutely. For everybody who's here with us today, thank you guys for showing up. You are the reason we do this. So if you guys have any questions whatsoever, reach out to me, Gabe at therealestateinvestingclub.com. And if you guys want to support the show, all we ask is you give us a like, subscribe, share, all that jazz. Other than that, I hope you guys have a great week. Keep rocking real estate, and I look for seeing you on the next episode. All right, before I officially sign off, I have a quick announcement to make. If you're interested in becoming a passive investor in one of my deals, my own company, Kaizen Properties, is looking for capital partners for our upcoming projects. We invest in what are known as recession-resistant assets, mainly self-storage facilities, mobile home and RV parks, and industrial properties. If you're interested in investing and would like to learn a little bit more about my company, our investing criteria, and some of the previous projects we've done,
Go to the Real Estate Investing Club podcast at therealestateinvestingclub.com and scroll all the way down to the bottom of the page. Click on the Invest With Us button. That'll pop up the investor form. Fill that out, and we will reach back out to you as soon as we can. Or if you prefer a little bit more of a personal touch, you can reach out to me at gabe@therealestateinvestingclub.com. So really, that is it. Again, it was a pleasure hanging out with you guys during this episode, and I look forward to seeing you on the next episode.